following the married put techniques and the rules in the blueprint, we're going to manipulate that put potentially as a second working asset. Now, how am I going to do that? Well, I entered these 4 positions into the portfolio tool naturally so that we could take a look at them. We already took a look at them, but I want to take a look at the proper married put structure, where that stands right now compared to the out-of-the-money married put, the in-the-money short-term covered call, and that conversion trade we looked at as well. So let's go into our portfolio, October 24th portfolio, simulated opening these positions on October 21st. I got my 2 married puts here. Here's our AFRM covered call, the in-the-money covered call at the 72 strike, and here is our conversion that we talked about using the same strike with the same expiration. Did get a small credit for that, a good credit for that, actually, not too bad. But again, the max return is only expected at 0.2%. So in my portfolio, I usually use the stock analysis view. It gives me the full description of each of the legs. We're organized by linked strategies. I see this cleaner than I see my accounts at Fidelity and at Tasty Trade because they're linked positions. But, you've got all this information here, and it's just showing me each individual leg. The reason why I use the stock analysis view of the various tabs, standard view, Greeks view, earning, and if you're more of a Greeks trader, naturally you'd be in the Greeks view. But over here to the side, we have where we stand right now with our positions. Okay, what is my current liquidation gain or loss? What's my future expiration gain or loss? And the best one right now is the in-the-money covered call. I'm not going to lie to you, because the stock hasn't shown that much movement. The married put I showed you is here. The married put I didn't show you is likely, and now that I look at it, it's not what I would have done. I would have gone to the 80 strike. I apologize for that, but it's still going to allow me to show something important. Following the rules in the blueprint, I would have bought AFRM holdings on the 21st, 74.50, same as we did the other married put, the covered call, and that little conversion that we shared. But I likely would have bought the June 77.5 put. Looking at it now, it probably would have been the June 80 put, or I think there was a May series, so I might have gone with the May 80 as well. But in any case, it did cost a fair amount, $17.70. This put is far out in time. Paid a high premium for it. In fact, the maximum risk is higher than I would have liked to have gone. It's up to 15.9%. I never go above really 8 in my married put portfolios. But just for an example, let's take this position. I'm 237 days out. Why? Because it satisfies the rules in the blueprint. Meaning that, yes, we'll get to Steve's question in a moment, I have a position with a controlled risk, double the risk I would normally take. I just put this in on the fly at 4:15 as I was getting ready for the webinar. An unlimited upside profit, but I'm going to use those 13 different income methods in the blueprint to eventually pay for that initial at risk, cut the risk down, and potentially bulletproof the trade where I have no risk. Okay. Now, why 237 days out in time? Because, number one, of what I discussed, the time decay curve of the options. The out-of-the-money married put, or buying that out-of-the-money protective put that Mike mentioned or asked about in comparison with the covered call, is here. 15 days out in time. 30. 60. Right here at the peak of the curve is usually about 90 days. That's when you start to see the more rapid drop-off of the remaining time value of your option. 120 days. 200 days. Okay, and I'm out 237 days. So in the first 30 to 60 days I'm in this position, I'm going to expect to see shorter time decay. And as the stock moves up and down, I still retain a lot of the time value initially paid into, and I can manipulate that as a second working asset. I'm buying a put 30, 20, 15 days out of time that's out of the money just to put a quick base in, throw some money in. This is a complete wasting asset. That's why we don't advocate it. And again, if I'm using covered calls, in the money covered calls, my apologies. I'm not doing that. I'm not buying a put with it because I've made the choice to follow it. All right, so this isn't the position I would have entered following the rules in the blueprint. I would have taken the May position at the 80 strike, most likely, or the June position. I'm not sure which. Doesn't matter. Well, I'll tell you what I would have probably taken, what shows up in the married put. Let's see if it's there. Let me go to the married put search real quick. AFRM is not on the first page, and so it would probably be on the second page. Okay, so AFRM is not in there right now, but you've got NVIDIA, you've got Palantir, you see the risks at 7.6%, 8.7%. That's good controlled risk positions. The NVIDIA one, yes, it's expensive, yes, but remember, with the stock at 186, I'm paying the 190 put. That's not as much as I thought. I'm paying $21 for it. 4 of that is intrinsic. 18 is the time premium. That's my true risk on the position, is 8.7%. That's the worst case scenario. Okay. All right. So anyway, let me go back to the portfolio. The covered call is doing the best right now. The stock is up. It's up to 75.39. We've gained 89 cents on the stock in the first 3 days. My long put out to June has lost only about half of that. It's losing as the stock goes up. I have a positive delta position. My put was probably at a delta of around 0.5 or 0.55. And that looks about right? And the stock's up almost 90. We're down 45, 0.55 delta, or 47, excuse me, 0.55 delta, 0.52 delta. Compared to the out-of-the-money short-term put wasting asset, which has lost almost 1-to-1 with the stock increase. I've lost half of this value on the longer-term put than I did on the shorter-term put. Even though I paid more money for it, it's still holding what? Most of that time value, because the time decay curve is one of the 3 core principles of radioactive trading. Forcing an ideal size trade, which will apply to Steve's question in just a moment. Taking advantage of the time decay curve and the at the money bell curve. Why do we buy in the money and why do we sell at the money? It's because that's where the best time value is. When you're buying, the best time value is slightly in or slightly out of the money. But if I go out of the money with the put far out in time, I'm going into double-digit risk. I know I'm on double-digit risk on this position because I just put it together as an example. But this illustrates what we want to see. We're losing a larger portion of the shorter term out of the money put because it's a wasting asset. I agree with you. It's not a bad thing to do if you think there's going to be a sudden market move and you want to hedge your stock positions. That's okay. But if I'm going long-term growth on a position, potentially generating income, I'm using it as a married put approach, following the rules in the blueprint. If I'm looking for short-term singles with good downside protection, I'm using a long collar, standard collar approach or the in-the-money covered call. Now I'm not trying to overthink it by saying, oh, I've got the in-the-money covered call. Should I keep buying a put against the in-the-money covered call? Like they say, buy a put at PowerOptions and RadioActive Trading and Options Animal. They say do the collars to protect the position. If you've made the choice that the in-the-money covered call approach with the good downside protection, high probability of being assigned and earning that return, and of course the return matches your trading goals, then you're just doing the in-the-money covered call. You're leaving it. You do leave your downside open in case of unexpected events. But what are we talking about again? The market or the stock dropping 6, 6.5, 7, 8% in the 10, 14, 20, 30 days you're in the position. Not for long-term growth, for shorter-term return. And how are we doing all right now? Again, with the stock up 1.2%, the out-of-the-money married put is only up $7 or 0.1% because it's lost almost 1-to-1 with the put. I'm at a 50% gain of the underlying stock with the married put right now. I'm not selling to close it. Why? Because the proper structured married put, I'm looking to hold longer term. The in-the-money covered call, hey, it's getting deeper in the money. Time value is decaying. Delta's getting closer to 1. We could liquidate right now in 3 days for a 1.1% return, but I'm looking for 3.6%. Not worried about the put. If the stock starts to fall, I'll just roll down the call, perhaps, depending on what PowerOptions shows me with the rollout opportunities. And the conversion, yeah, okay, but best we could do is 0.2% guaranteed profit. Right now we're at 0.1% loss if we liquidate. So again, probably not going to do it, but it probably didn't match our criteria going forward.